Before I get started, I'd like to just say a little bit about my background. I'm the president of Comprehensive Wealth Management. I'm also the president of a certified public accounting firm in New York that specializes in working with dentists. We do work with dental practices across the country. I'm a certified financial planner, have a master's degree in taxation. I am securities licensed, insurance licensed, pretty much anything financial related. I am qualified and uniquely positioned to work with you in those areas. The next chapter we're going to cover is managing your debt. I love this quote. Again, I'm not going to read it, but you guys could read that on your own. So the big question with debt is this. Is debt a good thing or is it a bad thing? The truth of the matter is it depends. And by the way, a lot of questions I'm going to ask you today, the answer will be it depends, right? Everything depends on the facts and circumstances. So if you charged up $30,000 in credit card debt right after you graduated dental school because you wanted to treat yourself to a nice vacation, a nice Rolex watch, and a few other fancy things, would you consider that good debt or bad debt? Well, quite frankly, we know the answer to that. It's bad debt. Now, bad debt is funded by your need to feel rich. So people end up spending money on things they can't afford. They get immediate satisfaction out of that so that they feel wealthy. But in fact, what you're doing is you're making yourself the opposite of wealthy. You're making yourself poor because you're putting yourself into debt. So remember, when you see your credit card bill accumulating and you see yourself not being able to pay it every month, that is a huge red flag, right? That's telling you you're spending more money than you're making and you're on the road not to success, but on the road to failure, and you need to stop that immediately. So speaking of credit cards are a means of payment. It's a convenient way to pay for things rather than using cash or having to write out a check. That's terrific, but sometimes it's a little too easy, and that makes people spend money on things that they shouldn't be buying in the first place. Accumulating credit card debt, in my opinion, is the equivalent of terminal cancer in the healthcare industry. It's the surest way to ruin yourself financially. At the end of this lecture, I'm going to talk to you about the secret of accumulating wealth. It's called the power of compounding. When you accumulate credit card debt, it has the absolute reverse effect on your financial situation. So I would encourage each of you, if you have multiple credit cards, get rid of them. Try to limit yourself to no more than one or two, and realize that if you can't afford to pay that bill at the end of the month, then don't even think about charging and buying whatever it is you were about to purchase. The other big item in this chapter has to do with loans. So many of you have student loans, and the big question you have to ask yourself, should I continue to pay this student loan? And the answer, of course, is yes, you should continue, but are you doing it in the best and most cost-effective way? Now, the tricky thing is that student loans right now, federal programs, there is a deferment on the interest. Actually, they're not charging interest, at least I believe it is until the end of the year. So that's a pretty good deal, and that's a gift the government has given us. The problem with the federal loans is that most students are paying 7% or more on average. So someone that owes $400,000, do the math, $7, $14, $28,000 a year. It's insane that somebody that owes $400,000 a year is paying $28,000 a year in student loan interest, and at the same time, none of that interest is tax deductible. So if you're in a 50% tax bracket, you have to earn twice that amount, give half of it to the government, and then all you're doing is covering your interest. So what I would encourage each of you to do is explore the possibility of refinancing your student loan debt, definitely starting January of next year. If you could cut that rate in half, that will be a significant savings and will put you on the path to getting those loans off your back at a much earlier time frame. The other issue is related to interest rates, which is very critically important right now. Because of the coronavirus, the Federal Reserve has dropped interest rates, and right now we are historically low interest rates. So what does this mean for you? Well, if you have a practice loan and you're paying 6-7%, there are some terrific programs out there right now where you might be able to get 3 or 4%. Even if you have to pay a prepayment penalty, let's assume for a minute you pay a 1% prepayment penalty. If you're cutting your interest rate by 4 percentage points, you're going to make up for that cost within 3 months of refinancing that loan. The same is true for home mortgages, any type of debt you have. If you borrowed money a year ago or longer prior to that, you definitely have to analyze your debt and determine whether or not it's going to be cost effective to refinance that debt so you can lock in a lower rate and take advantage of this historically low interest rates. As I said, I am the writer of this book. It's a second edition. It's loaded with wealth of information. I would encourage each of you to pick up a copy of this book. And if you have any other questions, I left up on the screen here my contact information. It was my pleasure speaking to you guys today. I'm hopeful that you found at least 1 or 2 things that you're going to put into place immediately in your own life that will make a big difference in your life. With that said, thank you for coming, and look forward to speaking to each of you again soon.